All right, let's dive into one of the most fascinating macroeconomic mysteries out there today. Look, if you follow global economics, you know perfectly well that inflation has been the absolute biggest headline of the decade. But over in Japan, the script is totally flipped. In this explainer, we're going to dig deep into a phenomenon that has literally puzzled economists for decades: the Japanese inflation paradox.
To really give you a sense of just how wild this divergence is, let's quickly look at the recent pandemic crisis. While the United States was getting hammered by a jaw-dropping 9% inflation rate, which as we know squeezed households and forced some pretty aggressive central bank interventions, Japan's absolute peak barely scraped 4%. And honestly, even that 4% felt like a massive anomaly to them.
Which naturally leads us to the big question for this explainer. Why exactly is inflation so stubbornly low in Japan, especially when the rest of the world has been dealing with skyrocketing prices? To answer that, we have to look way past the usual headlines and untangle the deep, structural, institutional, and corporate behaviors that actually run the Japanese market. Okay, part 1. The inflation paradox itself. Let's map out Japan's recent economic eras to get our bearings. Looking back over the data from the last quarter century, Japan went through some very distinct, fascinating phases. From 1998 to 2013, they weren't just fighting low inflation. They were locked in an outright deflation era where prices were literally falling. Then, from 2013 to 2020, they shifted into a low inflation era. Now, post-2020, we do see relatively higher inflation, but the data clearly shows this is mostly just a delayed reaction to global energy costs shooting up, not some organic surge in domestic consumer demand.
Moving to part 2, the deflation trap. Let's look at the monetary limits central banks face.
We've got to start with the classic Fisher equation. It basically tells us that nominal interest rates, the rates you actually see at the bank, are essentially just the sum of real interest rates and expected inflation. This equation is essentially the compass for central banks everywhere. Usually when inflation drops, a central bank lowers that nominal interest rate to get people borrowing, stimulate demand, and push inflation back up.
But here is the kicker. Since 1999, Japan has been slammed against what economists call the zero lower bound. Because nominal interest rates can't realistically be dropped below zero, Japan just hit a brick wall. They fell right into a deflation trap where interest rates hit absolute zero, completely robbing the central bank of its main conventional tool. No matter how much the economy slowed down, they simply couldn't cut rates any further.
So, part 3, corporate behavior. Since the central bank is effectively trapped, we have to shift our focus over to the corporate boardroom. To make sense of this, we need to talk about markup. Markup is essentially the premium a company charges you over what it actually costs them to manufacture a product. A high markup means a firm has serious market dominance. They can jack up the price and consumers are still going to buy it. On the flip side of that coin, we have markdown. This measures the gap between what a company pays its workers and the actual value those workers create. If markdown is high, it means companies are keeping wages suppressed, which, as we know, is usually tied to declining unionization and pretty weak worker bargaining power. And this right here perfectly illustrates the contrast. The data shows U.S. companies have generally been expanding their markups, using that market dominance to hike prices, which some analysts call greedflation, while keeping markdowns high, meaning wages stay suppressed. Japanese companies, though, they are trapped in a hyper-competitive deathmatch. Consumers there have immense choices, so this fierce competition forces Japanese companies to actively shrink their markups while still keeping markdowns high and wages low due to that declining union power. Check out how Japanese companies react when their own costs go up. It's wild. A survey by Bank of Japan researchers found that roughly 50% of Japanese companies actually choose to just eat the extra costs and slash their own profits, rather than passing those price hikes on to their consumers. 50%! Their absolute biggest fear is losing a price war to competitors, so they just absorb the pain themselves. And naturally, internalizing all those costs hits the workforce hard. A labor ministry survey showed that when it's time to set wages, barely 10% of Japanese companies even look at inflation. They base pay strictly on company performance. But because they're already cutting their own profits to keep prices low, performance suffers, and employees don't get the raises they need to actually fuel domestic consumer demand. It's just a brutal, self-fulfilling loop of low prices and low wages.
All right, part 4, the missing money. This brings up the most obvious question about quantitative easing. If they printed astronomical amounts of money for 2 decades, why didn't it trigger runaway inflation?
The data absolutely confirms they turned the spigots all the way on.
If we look at the M3 money supply relative to GDP, that ratio just exploded in the 2000s. The central bank's money printer was going full speed. Now, traditional theory says if you pump that much cash into a system, demand outpaces production, and boom, you get inflation. But in Japan, the money supply growth totally outpaced the actual inflation rate, which barely budged.
So, where did all that newly printed money actually go? Well, it definitely wasn't stuffed under millions of mattresses. It totally bypassed the everyday domestic consumer. A huge chunk of it flowed straight into foreign financial markets. Think investors snapping up U.S. assets or emerging market bonds. Domestically, it fueled corporate financialization, meaning non-bank companies were busy making financial investments instead of, expanding local factories or hiring more people.
And that right there is the missing link in this whole paradox. Quantitative easing fundamentally failed to trickle down into everyday consumer credit. The banking sector just didn't channel this new money into the types of loans that drive daily domestic demand. As a result, all that new wealth stayed locked up in financial assets, pumping up the markets, but leaving the real economy, everyday goods and services, pretty much untouched.
Finally, Part 5, Systemic Forces, because this paradox forces us to look way beyond just the money supply. We have to remember that Japan hasn't been operating in a vacuum. For 3 decades, they have been relentlessly battered by external shocks. From the devastating 1990 asset bubble bursting to the 97 Asian financial crisis, the 2008 Lehman shock, and of course the recent pandemic mixed with a rapidly depreciating yen. Every single time a crisis hit, the central bank was already paralyzed with 0% interest rates. They had literally no conventional ammunition left to fight back.
Yet, despite all these massive, unique structural hurdles, the Bank of Japan still stubbornly clings to a 2% inflation target, mostly just to keep up appearances with the US and Europe. But as we've seen today, the market expectations make it glaringly obvious that this target is totally divorced from Japan's economic reality. It's basically a target imported from economies that behave entirely differently.
Japan completely shatters the idea that the macroeconomy is as simple as turning a dial on a money printer. So, I'll leave you with this to chew on as we wrap up this explainer. Based on this incredible paradox, is inflation really just a monetary phenomenon about how much cash a central bank prints? Or is it fundamentally driven by deep-rooted corporate behavior, cutthroat market competition, and how wealth is actually distributed between capital and labor? Keep questioning the data, and thanks for joining me.